Hello. Chapter 13 lecture focused on how to prepare what's known as classified financial statements. Now, classified doesn't mean it's a secret. Little joke, okay? Classified means these statements are broken down into several categories. And the more categories provided, the more details we can learn about that business organization. We'll first look at what's known as a classified income statement. When you think about an income statement, it can consist of your revenue accounts and your expenses. Now, that has not changed, but with the classified income statement, also known as the multiple step income statement, we're going to take our revenue account expenses and put them into different subtotals within the groups, meaning that we're going to have different sections, different classifications shown on the classified income statement. Now, the classification depends upon the type of business. Meaning, are you a company that provides a service or a company that sells a product? Or it could be a combination of the two. So depending upon the type of business, that will impact the actual setup of the structure for your classified income statement. The first section of the classified income statement focuses on what's known as operating revenue. When you think about operating revenue, this is revenue earned from our principal or our primary type of business activity. For our example, that's going to be sales. We are selling an actual product. So sales represent our principal or our primary type of business activity. We have a new account title called Sales Return and Allowances. This is a contra revenue account. This account shows items that were sold but then returned back to the actual supplier. Or we may grant someone an allowance because we sold them a product, but maybe the product was somewhat defective. It was damaged in delivery, had a mark on it, it was scratched up, and we gave them a reduction from the original price. That's known as a sales allowance. When you subtract your sales return allowances from your total sales, that would give us what's known as net sales. So sales less return allowances gives us what's known as net sales. This is the first section shown on the classified income statement for a company that sells actual products. So Whiteside Antiques is our company, and they're selling an actual product. They had net sales for the year of $549,150. Okay. The next section is called Cost of Goods Sold. This section contains information about the cost of the merchandise that was sold to our customers during the accounting period. So it represents the amount the company paid for those items that were sold to their customers during the course of the accounting period. There are three elements that make up the cost of goods sold section of the classified income statement. Those elements are beginning inventory, net delivered cost of purchases, and ending inventory. Again, beginning inventory, net delivered cost of purchases, and ending inventory. If we know these three amounts, we can calculate what's known as cost of goods sold. Okay? So we go back. So beginning inventories shows the amount of inventory we had available at the beginning of the accounting period. Ending inventory shows what we have remaining at the end of the accounting period. And we'll look at what factors gives us what's known as our net delivered cost of purchases. To calculate your net delivered cost of purchases, we take our purchases. That's the actual cost we pay for the merchandise we're going to purchase during the accounting period. Add in freight in, which is the shipping cost to receive those items. Subtract out any purchase return. So if we return an item during the course of the accounting period, that's known as a purchase return allowances. Purchase discounts takes place when we make a payment by a certain time period. They may give us a discount that's known as a purchase discount. So you take your purchases, add in your freight in, minus your returns allowances, and minus any purchase discounts, and that will give us what is known as our net delivered cost of purchases. You'll take your beginning inventory, what you had available at the beginning of the year, add in your net delivered cost of purchases, which show what we acquired during the course of the current accounting period. And when you add those two together, we call that our total merchandise available for sale. Some books call it cost of goods available for sale. It shows the amount of inventory that we had available to be sold to our customers during the course of the accounting period. Okay? So we'll then subtract what we have remaining from what was available, and the difference is known as your cost of goods sold. So cost of goods sold represents the amount the company paid for the merchandise that was sold to their customers during the course of the accounting period. To calculate it, you would take the amount available for sale minus your ending inventory, and that would give us what's known as our cost of goods sold. So here we have a partial classified income statement. Here's your beginning inventory was $52,000. To get your net delivered cost of purchases, we'll add the purchases plus our freight in. We'll add those together, subtract out the purchase return allowances and the purchase discounts, and that will give us our net delivered cost of purchases for $325,120. So now add the beginning inventory plus your net delivered cost of purchases. When you add those two together, that's known as your total merchandise available for sale, which totaled $377,120. This shows the total amount of inventory that was available to be sold to our customers during the course of the accounting period. Now, from that total, subtract out what you have remaining, which is your ending inventory, and the difference is known as your cost of goods sold. So our cost of goods sold amount would be $330,120. Next, gross profit on sales. Difference between the actual amount that we sold the items for, net sales, minus our cost of goods sold, gives us our gross profit on sales. Again, net sales less cost of goods sold equals your gross profit on sale. We sold the items for $554,000. No, we didn't. For $549,150, what we sold them for. We paid for those items $330,120, which gave us a gross profit of $291,000. $19,030. Okay? We'll next look at the category known as our operating expenses. When you think about operating expenses, these are what we call the cost of doing business. There are certain expenses that must take place in order to earn revenue for a business organization. For this example, they broke it down between two different categories: selling expenses and what we call general and administrative expenses. When you think about selling expenses, these are the direct cost of selling the actual product. So think about having an actual store location. So the salaries of the store staff, supply for the store, advertising, depreciation, or all direct cost of selling the product, those are known as selling expenses. When you have your general and administrative expenses, we call these indirect costs of selling the product. So now think about the corporate office. Go back. Think about the corporate office. So rent for the corporate office, salary expense for those in the office like the president, the vice president. These are what we call indirect costs, known as general and administrative expenses. So for each of these categories, you get a subtotal for the selling expenses and the same for the general and administrative expenses. You will add those together to get total operating expenses, in this case, $167,833.80. Now, we're going to subtract, we're now going to subtract the total operating expenses from our gross profit to get our net income from operation. Again, subtract the total operating expenses from your gross profit on sales to get your net income from operations, in this case for $51,196.20. We're almost done. Next, we have what's called other income and other expenses. These are income from sources other than our principal business activity and expenses from sources other than our principal business activities. So think about these as being what they call secondary income and expenses. Get a total for your other income and a total for your other expenses. Depending upon which is greater, you either have a net non-operating income or a net non-operating expense. Since the expense is greater, we have a net non-operating expense for $238. Now, to complete the income statement, we're going to subtract the net non-operating expense from our net income from operations to get net income for the year for $50,958.20. Now, if you had a net non-operating revenue, you would add that to net income from operations to get your net income for the year. So here you have it, ladies and gentlemen. This is your first classified income statement. We're now going to prepare next what's known as a classified balance sheet and our statement of owner's equity.